Welcome to our video on how to make money in stock market trading. Trading in the stock market can be a way to potentially make money, but it's important to note that it also involves risks. Here are some general guidelines to consider if you're interested in trading stocks. Educate yourself. One of the most traditional methods is through books. There is a wealth of literature available on the topic, written by experienced traders, investors, and financial experts. Look for books that cover the basics of stock market trading, technical analysis, fundamental analysis, and trading strategies. These books can provide you with a solid foundation and help you grasp the essential concepts. Online courses have also gained popularity, offering structured learning experiences at your own pace. Look for reputable platforms or educational websites that offer comprehensive courses on stock market trading. These courses often include video lessons, quizzes, and practical exercises to help you apply your knowledge. Seminars and workshops can be a valuable way to gain insights from industry professionals. These events often feature experienced traders who share their strategies, tips, and real-life experiences. They provide an opportunity to ask questions and interact with other participants who share your passion for trading. The internet is a treasure trove of information. Explore reputable financial websites, blogs, and forums dedicated to stock market trading. These platforms offer a vast array of articles, tutorials, and discussion forums where you can learn from experts and engage with the trading community. Develop a trading strategy. First and foremost, define your trading goals. Ask yourself what you aim to achieve through trading. Are you looking for short-term gains or long-term wealth accumulation? Clarifying your objectives will help shape the rest of your strategy. Next, explore various trading styles and identify the one that aligns with your goals, risk tolerance, and time commitment. There are several common trading styles to consider, such as day trading, swing trading, position trading, and long-term investing. Each style has its own advantages and requires different approaches. Once you've chosen a trading style, it's time to determine your preferred markets and securities. Will you focus on individual stocks, exchange-traded funds, ETFs, options, or futures? Each market has its unique characteristics, liquidity levels, and associated risks. Consider your knowledge and comfort level before. Fundamental analysis is another crucial aspect of developing a trading strategy. This involves evaluating a company's financial health, industry position, competitive landscape, and overall market conditions. Learn to assess factors such as revenue growth, earnings reports, balance sheets, and economic indicators. This analysis will help you identify potentially profitable opportunities. Technical analysis complements fundamental analysis by focusing on price patterns, charts, and indicators. Learn about popular technical analysis tools, such as moving averages, support and resistance levels, trend lines, and oscillators. These tools can help you identify entry and exit points, as well as potential trend reversals. Conduct fundamental and technical analysis. Fundamental analysis involves assessing the underlying factors that can influence the value of a stock or company. It starts with researching and analyzing the company's financial statements, including income statements, balance sheets, and cash flow statements. By examining these documents, you can gain insights into the company's revenue, profitability, debt levels, and overall financial health. In addition to financial statements, fundamental analysis includes evaluating the broader market and industry conditions. Stay informed about industry trends, competitive dynamics, and regulatory developments. Understand the company's position within its industry and how it may be impacted by factors such as technological advancements, consumer behavior, or economic conditions. Technical analysis, on the other hand, focuses on studying price patterns, charts, and technical indicators to identify potential trading opportunities. By analyzing historical price data, you can identify trends, support and resistance levels, and chart patterns such as triangles, double tops, or head and shoulders formations. Technical indicators such as moving averages, relative strength index, RSI, stochastic oscillators, or Bollinger Bands can provide additional insights into market trends, momentum, and overbought or oversold conditions. These indicators help you assess the timing of your trades and potentially spot entry or exit points. To make well-informed trading decisions, it's often beneficial to combine fundamental and technical analysis. By incorporating both approaches, you can gain a more comprehensive view of the market and increase your confidence in your trading decisions. Stay updated with relevant news and events that may impact the stocks or markets you're interested in. Economic indicators, earnings reports, product launches, regulatory announcements, or geopolitical events can all influence stock prices. By integrating fundamental analysis with up-to-date market information, you can make more accurate assessments of the potential impact on your trades. Practice with paper trading. Paper trading, also known as virtual trading or simulated trading, is an invaluable practice tool for aspiring traders. Let's explore the benefits of paper trading and how you can use it to enhance your trading skills. Paper trading allows you to simulate real trades without risking your actual capital. It provides a risk-free environment where you can practice executing trades, test your trading strategies, and gain valuable experience in the market. To get started with paper trading, sign up for a virtual trading platform. Many brokerage firms offer paper trading accounts, or there are standalone platforms available specifically for this purpose. These platforms provide you with virtual money and a simulated market environment to trade stocks, options, or other securities. Once you've set up your paper trading account, begin by researching stocks, studying charts, and identifying potential trading opportunities. Use the same techniques you would in real trading, such as conducting fundamental and technical analysis to make your trading decisions. Execute your trades on the paper trading platform, just as you would in a live trading environment. Monitor your virtual portfolio, track the performance of your trades, and assess the outcomes. This process allows you to understand the impact of your trading decisions and see how your strategies perform in different market conditions. One of the significant advantages of paper trading is the ability to learn from both successful and unsuccessful trades. Analyze your paper trades, identify patterns, and evaluate the effectiveness of your strategies. Adjust your approach as needed, learning from any mistakes or areas of improvement. Consider maintaining a trading journal during your paper trading practice. Record your trades, the rationale behind each decision, and your observations. This journal can serve as a valuable reference and help you track your progress over time. As you gain confidence and consistently achieve positive results in your paper trading, you may consider transitioning to real trading with actual capital. However, it's important to start small and gradually increase your position sizes as you gain experience and confidence in your abilities. Set a budget and manage risk. Setting a budget and effectively managing risk are essential elements of successful trading. Let's explore how you can establish a budget and implement risk management strategies to safeguard your capital. The first step is to set a trading budget. Determine the amount of money you are willing to allocate for trading purposes. This should be an amount that you can afford to lose without negatively impacting your financial well-being or other obligations. Once you have established your trading budget, it's important to define your risk-reward ratio. This ratio represents the potential reward you aim to achieve in relation to the amount of risk you are willing to take. A common guideline is to aim for a risk-reward ratio of at least 1:2, meaning that your potential profit should be at least twice the amount you are risking. Implementing risk management tools, such as stop-loss orders, is crucial for managing risk. A stop-loss order is a predetermined price level at which you will exit a trade to limit your potential losses. Set your stop-loss levels based on your risk tolerance and the price levels that would indicate an invalidation of your trading setup. Diversification is another important aspect of risk management. Avoid putting all your eggs in one basket by diversifying your trading portfolio. Spread your capital across different securities, sectors, or asset classes. This helps to mitigate the impact of any single trade or market event on your overall portfolio. Thanks for watching.